We're now 6 days out from the Iowa caucus, 9 days from a government shutdown deadline, and fewer than 300 from the general election. Now, while my next guest points out stocks in election years with the sitting president outperform open election years by 13 percentage points, 2024 is still off to a rough start. Here to discuss is Dan Clifton. He's Strategas head of policy research. Dan, I don't know what happens when you mix election year with January barometer. What kind, I don't know if those two indicators can coexist.
Yeah, I don't know if they can coexist either, or even, an election year with earnings starting to slow. Those are things that we have to consider. But Kelly, I think this is very important. The S&P 500 has not declined in a presidential reelection year since 1940. So you're talking about 13 consecutive presidential election years in a row. And as you alluded to in your opening, there's a wide outperformance between reelection years and open election years. And what that tells us is that presidents have a lot of levers available to them to be able to influence the economy because, hey, they like getting reelected.
Sure.
And this president clearly wants to get reelected. You're likely going to see a lot of those tools get used this year, especially in a year where the election is likely going to be close. And there's these extra variables outside that are going to be able to weigh on how this election goes. So this is going to be a wild year, and it's going to be a fun year, I think.
Yes. We just showed your chart that shows the outperformance of the market in incumbent election years. But what's the difference when an incumbent gets reelected versus a change of party?
Yeah. It's the same thing, right? When you get a very good S&P 500 when the president gets reelected, and we think that happens is that the investors can figure that out by the end of the convention season in July and August, and then it's off to the races in September and the market worries about something else. When the opponent loses or when the opponent wins, you tend to get a big sell-off in September or October as there's more uncertainty about a new president coming into office. What's going to be that person's tax policies or trade policies? But those tend to be temporary, and you do still get an increasing stock market on average, even when a challenger wins the election. So some of these are kind of more dips than anything else. But largely, it is about kind of navigating this. And as we get deeper into the election, it's going to have a bigger impact on sectors than the overall S&P 500.
And you're always so good at diving into that. So I don't know if my last question should be about those sectors, about the fact that you say the market often sells off around Super Tuesday, March 5th. Maybe that's something to keep an eye on. And the third prong of this would be, do we need to pay attention to this potential government shutdown, I guess, next Friday?
Absolutely. So we're talking about a partial government shutdown next Friday. And I don't think it's going to have a big macro effect when we actually go through that partial government shutdown. But you can see the noise is really ramping up from Washington. You're going to have the Iowa caucuses on Monday and then a potential government shutdown on Friday. The market's going to have to digest a lot of these, what I would call political noise, and it's really ramping up, something that we didn't see in 2023. And why this is important is that once you start getting into the election, how the Fed is moving forward on monetary policy, how the Treasury is financing the deficit, those are going to be important factors about whether we're going to be able to digest a lot of this political news. But if you start to get liquidity being drained from the financial markets while you have those political news, there could be some rough roads in the stock market until it gets resolved.